Welcome to this event. I am Joaquin Vespignani, Associate Professor of Economics at Tasmanian School of Business and Economics, University of Tasmania, and co-director of the COVID-19 and the Macroeconomic Research Program at CAMA with Professor René Frey-McGivens. We are excited to hear presentations from John Blurdon, Ian Coase, and Warwick McGivens on global economic impact of COVID-19. Let's start with the bios. John Blurdon is a Deputy Division Chief on the World Economic Outlook in the IMF Research Department. Previously, he has been a Senior Economist in the Research Department Structural Reform Unit, a member of the IMF Euro Area team in the European Department, and work on the World Economic Outlook as an economist. Before joining the IMF, he was a professor at the University of Southampton in United Kingdom after a postdoctoral fellowship at the University of Oxford. Mr. Blurdon has published on a range of topics in international finance, macroeconomic, and development. He holds a PhD from the University of California at Berkeley. Ian Coase is a director of the World Bank Group, Prospect Group. Mr. Coase is a non-resident senior fellow at the Brooklyn Institute, a research fellow at the Center for Economic Policy Research, and a dean fellow at the University of Virginia Darden School of Business. He has previously assistant to the director of the research department, a deputy chief of the Multilateral Surveillance Division in the IMF. He taught at the University of Chicago Booth School of Business and the Brainerd International Business School. Professor Warwick McGivens is a professor of public policy and director of the Center for Applied Macroeconomic Analysis in the Crawford School of Public Policy at the Australian National University. He is also a director of policy engagement and the ANU node leader, the ARC Center for Excellence in Population Asian Research. He is an ANU Public Policy Fellow, a Fellow of the Australian Academy of Social Science, a distinguished Public Policy Fellow of the Economic Society of Australia, a distinguished Fellow of the Asian and Pacific Policy Society, a non-resident Senior Fellow at the Brooklyn Institute in Washington, D.C. Professor McGivens was a foundation director of the ANU Center for Applied Macroeconomic Analysis, the foundation director of the ANU Research School of Economics. Professor McGivens served for a decade on the board of the Reserve Bank of Australia until July 2011. He has also served as a member of the Australian Prime Minister's Science, Engineering and Innovation Council and the Australian Prime Minister's Task Force on uranium mining, processing, and nuclear energy in Australia. He was awarded Centenary Medal in 2003 for service to Australian society through economic policy and tertiary education, and made an Officer of the Order of Australia in 2016. Now we will hear from each of the three speakers, about 15 minutes each, and then we open for questions. A little bit of housekeeping. If you would like to ask a question, please ask questions by using the Q&A function. You can type your question into the Q&A box. If you would like to ask your question via your microphone, please use the raise your hand function on Zoom, and I will allow you to turn on your microphone so that you can pose the question directly to the panel. If you would like to ask your question on video, raise your hand, and also send me a private chat message to let me know that you would like to turn on your camera. Before we begin, I would like to let you know that we are recording this session, which will be available on the CAMA website after the event. I will now pass to Sean to start the presentation. Thank you.
Thanks very much, Joaquin. So I'm going to share my screen here. Okay. Great. So hopefully you can see the slides. So thanks much for the introduction and the opportunity to present this latest set of IMF projections, which have just been released actually today, earlier this morning, Washington time, as part of our quarterly update on the world economy. So the COVID-19 pandemic has pushed many economies, well, all economies, into a great lockdown, triggering the worst recession since the Great Depression. Many are now reopening, but to an uneven and uncertain recovery. As compared to the April World Economic Outlook, the green line in the leftmost panel here, we are projecting that output will decline more sharply in 2020 and recover more slowly than we had expected. There are many risks at this conjuncture, making the projections highly uncertain. In particular, there is uncertainty about how the pandemic will evolve. Will the virus change? Will there be a second wave in countries that reduced infections? If so, how effective are the tools to handle it? Could a medical solution, vaccine, or treatment be found sooner than expected? Other sources of uncertainty are more economic and political. Financial conditions could tighten unexpectedly, particularly given historically high debt levels. There could be a rise in geopolitical tensions and social unrest. It may be that the drop in activity leads to more profound scarring of the economy than expected, leading to a more sluggish recovery. Policies are going to need to adapt to the situation. They will need to ensure that health systems are supported and resourced, shield people and firms impacted by the crisis, and as recovery unfolds, support hiring and enable the reallocation of resources as required. They will also need to ensure that the financial system remains sound and take the opportunity to put in place measures to foster the growth of a more inclusive and greener economy in the recovery. International support will be critical for vulnerable countries and to improve the global system. Let's take a look at how the lockdown has evolved over recent months. There are three phases to the Great Lockdown. In the first phase, shown in the first row, countries entered lockdowns, and this continued through March. In the second phase, shown in the second row, countries tentatively exit, ideally as outbreaks are brought under control, and many countries are in this phase now. However, without a medical solution, they could re-enter lockdowns. The third phase is when there is a vaccine and countries finally escape from the lockdown. As you can see, the world is in the second phase, while as the third row shows, the number of global cases continues to rise, recently driven by rising numbers in emerging market and developing economies. As this slide shows, with a look at the cumulative number of confirmed cases around the world, the pandemic is everywhere. Advanced, emerging market, and low-income economies with varying levels of severity. Recently, the epicenter has shifted to Latin America, seen in the middle panel. In LICS, shown in the right panel, confirmed cases overall are lower, likely reflecting a mix of demographics, poor measurement, and luck. Zooming in on the recent period and focusing on only new cases, we can see where outbreaks are declining, plateauing, or still increasing. Among AEs, the US is at a notably higher flow of new cases. As of last week, it was plateauing, but I think this may be rising again. In EMDEs, Brazil is still on a rising trajectory, whereas China, the country first impacted, has seen new cases plummet. Shifting now to economic indicators, we can see that this is a crisis like no other, playing out in unique ways. As seen here, the surprise economic losses in countries that we've seen in the first quarter are related to the severity of the pandemic, with growth forecast errors becoming more negative as the per capita death rate from COVID-19 rises. That's in the left panel. Countries with larger drops in mobility metrics, a high-frequency proxy for economic activity that also appears negatively related to pandemic severity, also had worse than expected growth in the first quarter. That's in the right panel. We'll learn more from second quarter data releases as they roll out over the next couple months. Another feature of this crisis is that the services sector has been hit even harder than manufacturing, as seen in the two leftmost panels in the month of April. PMIs dropped much more in services than manufacturing. This is unlike previous crises and reflects the impact of de jure and de facto lockdowns on consumption. Services PMI in April shows a strong relationship with what happened according to mobility metrics. That's in the middle there. In May, as countries reopened, the PMIs improved but remain in contractionary territory. There has also been an abrupt collapse in employment in some countries, as seen in the right panel, most notably Canada and the US here. Now, accompanying this shock, there has been unprecedented monetary and fiscal policy support, across both advanced and emerging market and developing economies. Fiscal support has come in a mix of spending and tax measures, as well as loans and guarantees, as seen in the left panel. In advanced economies in particular, many of the support packages include an expansion of the social safety net scheme for workers, such as short-term work support or unemployment insurance benefits, seen in the middle. These enhanced schemes help to keep furloughed or unemployed workers home and slow outbreaks while coping with income losses. On the monetary policy side, we also started to see emerging markets expanding their monetary policy tools to unconventional monetary policy, such as asset purchases. That's in the right. These swift actions of large central banks has lifted investor sentiment and stabilized emerging market portfolio flows starting in April, which had previously been dropping. So now we're going to shift to the projections, but before then, let me give a brief description of the baseline assumptions underlying them. First, there is a larger hit to activity in the first half of 2020 than we had assumed back in our April projections, with more persistent social distancing and in some cases lockdowns into the second half of 2020. There's also greater scarring of the economy, slowing the recovery. Countries where infections have declined are assumed to not reinstate stringent lockdowns that were seen in the first half of the year. Second, financial conditions remain approximately at their current levels around the world. The projections also factor in the impact of the sizable fiscal countermeasures implemented so far and anticipated for the rest of the year. And third, commodity prices are broadly unchanged from April 2020. So the oil spot price is just over $35 a barrel for 2020 and 2021, then picking up gradually. As we see here, global growth we have projected at minus 4.9% in 2020. And that's about 1.9 percentage points below what we expected in April. Consumption growth in particular has been downgraded for most economies, reflecting the larger than anticipated disruption to domestic activity. In 2021, growth is projected to strengthen to 5.4%. That's 0.4 percentage points lower than we had expected in the April forecasts. For the group of advanced economies, that's in the second column here, growth is projected at minus 8% in 2020, about 1.9 percentage points lower than in the April WEO. There appears to have been a deeper hit to activity in the first half of the year than we had anticipated, with signs of voluntary physical distancing even before lockdowns were imposed. This also suggests a more gradual recovery in the second half as fear of contagion is likely to continue. Growth in the advanced economy group is projected to strengthen to 4.8% in 2021, but this leaves GDP for the group overall about 4% below its 2019 level. The projections for Australia, which is in the last column here, have actually been revised up for 2020, reflecting a somewhat stronger than expected first quarter, and that's now at minus 4.5% for the year. But these have been revised down to 4% in 2021. Turning to the group of emerging market and developing economies, growth in 2020 is now forecast at minus 3%. If we were to exclude China, it would be minus 5%. This is 2 percentage points below the April World Economic Outlook. For the first time, all regions in the world are projected to experience negative growth in 2020. In China, growth is projected at 1%, supported in part by policy stimulus. India's economy is projected to contract by 4.5% following a longer period of lockdown and slower recovery than anticipated in April. In Latin America, where most countries are still struggling to contain infections, The largest economy, Brazil, is projected to contract by 9.1%. The disruptions due to the pandemic, as well as significantly lower disposable income for oil exporters after the dramatic fuel price decline, imply sharp recessions of minus 6.6% for Russia and minus 6.8% for Saudi Arabia. Growth among low-income developing countries is projected at minus 1% in 2020, and that's about 1.5 percentage points below the April projections, although there's many differences within that group across individual countries. In 2021, the growth rate for emerging market and developing economies is projected to strengthen to 5.9%, partly reflecting the rebound forecast for China to 8.2%. The 2021 growth rate for the group excluding China is expected to be 4.7%. The downward revision to growth prospects for emerging and developing economies over the next 2 years exceeds that for advanced economies, as the hit to activity is now projected closer to the downside from our April projections. The downgrade also reflects larger spillovers from weaker external demand. We have global trade projected to contract by 12% in 2020. Overall then, looking at the quarterly pattern for advanced and emerging market and developing economies, we can see the sharp drop in 2020 Q2 and only a partial recovery, with output still expected to be below the level anticipated back in the January 2020 projections. Excluding China, you can see an even sharper decline in emerging market and developing economies and a worse cumulative outcome by the end of 2021 than advanced economies. That's at the far right here, compared to what we had expected before the pandemic. As part of the update, we also considered a couple of alternative scenarios, one with a second outbreak in early 2021, further hurting activity, and a second where the recovery is faster than expected. In the downside scenario, containment measures are assumed to be roughly half the size of what is already in the baseline for 2020, and there is some additional tightening in financial conditions. Despite the policy response, which has a very limited tightening of financial conditions in advanced economies and additional discretionary measures, the outbreak is assumed to cause further, longer-lived damage to the supply side of economies starting in 2022. As you can see, in this case, the world activity in 2021 remains about 4% below its 2019 level. In the upside scenario, the recovery is faster than expected as greater confidence in post-lockdown measures leads to more effective containment and less precautionary behavior. This implies 50% less scarring than in the baseline starting 2021. In this case, global output ends up about 3% above its level in 2019. Now, as I mentioned at the top, there are huge uncertainties and risks around the projections. For example, the pandemic itself could reaccelerate and a second wave emerge with all the attendant consequences for activity. At the same time, on the upside, it could be that some countries see greater success than expected at controlling infections, or a medical solution could arise sooner than expected. Another risk is that financial conditions could reverse. Social unrest could pick up with the economic dislocations from the pandemic. Tensions around trade and different responses to the pandemic across countries could also tick up. Scarring from the crisis could be worse than we've expected. Bankruptcies seem likely to rise, but they could be even more numerous, dissolving many previous economic relationships. Poverty and inequality could be even higher than anticipated. Against this backdrop, what are the policy priorities? It depends on context. When infections are accelerating, policymakers will need to maintain the functioning of essential sectors like healthcare and food, infrastructure and utilities. They will also need to provide resources for people hit by the crisis, which could be delivered through targeted measures such as wage subsidies and cash or in-kind transfers. Finally, it's critical to ensure that temporary support is provided to prevent excessive economic dislocations, particularly when the crisis is acute. When economies are reopening, it's going to be important to rebalance fiscal support and gradually unwind these targeted measures with the aim for policies to facilitate recovery and adaptation easing the reallocation of resources from shrinking to growing sectors. Continued central bank support for financial conditions will be key, as will measures to ensure that the financial system itself remains sound and can support the recovery. Finally, there's an opportunity to put in place policies that make the recovery greener, more inclusive, and digitally friendly, helping address ongoing challenges of climate change and inequality, and making the economy more resilient. International coordination and support are also essential to address the global nature of the crisis and also help more vulnerable economies weather it. This requires a mix of measures guaranteeing access to critical medical supplies and data, providing international liquidity through central bank swap lines, and resources for economies facing financing crunches to provide critical services. The IMF and other international financial institutions have a role to play in providing surveillance, economic advice, and lending. And I'll conclude here for now.
Thank you. And thank you for inviting me to share our views on the state of the global economy. Let me share my screen quickly. So presentation I'm going to give today is based on June 2020 Global Economic Prospects Report. We released the report on June 8th, almost 2 weeks ago now. My presentation is going to focus on 3 questions. First, what are global growth prospects in the near term? Global economy is experiencing the deepest and most synchronized global recession since Second World War. For the emerging market developing economies, this will be the first recession on record. Risks are still tilted to the downside. Second, what are the likely long-term implications of COVID-19? It's likely that after the pandemic, we will end up with weaker potential output, weaker investment, and weaker productivity over the long term. And finally, I will turn to policy priorities. And there, the big issue is to address the immediate health crisis while thinking about reforms to reignite growth down the road. Coordinating policies globally is critical in this context. Throughout the presentation, I'm going to use this acronym, EMDs, that refers to emerging market and developing economies. Let me start with the first question. Now, the global economy has experienced major disasters before, including pandemics and epidemics. But it has never experienced this type of overwhelming policy response to contain a crisis. In this case, a health crisis. Around the world, countries implemented unprecedented measures to contain the virus. When you think about the school closures, when you think about event cancellations, work closures, travel restrictions, these affected activity everywhere. In the case of school closures and event cancellations, actually the impact has been felt in almost all countries. Now, the implications of these necessary measures reflected themselves in mobility indicators you see on the right. Whatever mobility indicator you look at, whatever country group you look at, you see an outright collapse in mobility, whether it's associated with transit, whether it's associated with retail transactions, or whether it's associated with work-related business transactions. Now, the measures were necessary and they were in place. The implications for activity were truly unprecedented. You can look at the basic high-frequency indicators. You can look at indicators related to trade. You can look at indicators related to financial markets and commodity markets. Here, some of these indicators are presented in the slide. For example, if you look at new export orders, we saw steepest 1 month decline in April 2020, since 2000 in this indicator. If you look at tourist arrivals, in some countries, of course, that number went down to 0, but we saw in March 2020, tourist arrivals collapsing more than 60%. Early part in the crisis, what we see during March 2020 was an outright collapse in net portfolio inflows to emerging market developed economies. And of course, in the case of oil prices, we have seen something we did not see before, the sharpest 1 month oil price fall in March 2020, at least since 1960. Against this background, we are looking at a historical global recession. Now, before I talk about the forecast of the World Bank, I should say that the aggregation methodology is different in the sense that the World Bank uses market exchange rate weights when it aggregates its growth numbers, when it reports forecasts. In the case of IMF uses purchasing power parity weights when it computes its forecast. So in the case of IMF, emerging market developed economies have a larger weight. In the case of World Bank, advanced economies have larger weight when we think about the global growth numbers. Now, how do we see global growth in 2020 and 21? We are expecting a contraction around 5.2% in 2020. I'm going to show you what does this mean in historical context very soon. But it is truly a striking number. Advanced economies will contract by about 7% this year. And emerging market developed economies will see their first contraction since 1960 at least. And that's pretty much, I would call, on record. Now, these economies, emerging market developed economies, were able to deliver growth year in, year out for this period over the past 60 years. This year, they will end up with a deep recession. Now, the World Bank operates in 6 regions. And if you look at those 6 regions, other than East Asia and Pacific region, we are expecting outright contractions. In the case of East Asia and Pacific, we are expecting China to grow at about 1% this year. That will push the regional aggregate to 0.5%, a positive growth. China is the only major economy that's going to register positive growth this year. All advanced economies and other major emerging market developed economies will experience sharp contractions. Turning to regions, what do we see? We see that some regions are going to be affected more than the others. For example, in the Latin America and Caribbean region, growth collapse is going to be around 7.2%. This will be the largest decline this economy, the regional economy, has seen since 1960. Of course, Latin America and Caribbean is a commodity exporting region. It has a number of countries relying on tourism revenues. It has a number of countries relying on remittances. And of course, it trades a lot with big economies like the United States, China, and the Euro area. Some other regions will also see sharp contractions. Europe and Central Asia, Middle East and North Africa, they will be affected by the collapse in commodity prices and collapse in partners' growth. In the case of South Asia, a region that doesn't have any commodity exporting economy, there will be contraction as well, as India will see growth about minus 3.2% this year. Sub-Saharan Africa will also see a sharp contraction as the region's largest economies, South Africa, Nigeria and Angola will see contractions. Next year, we are expecting an expansion, but that expansion is going to be a modest one. At the global level, growth will be around 4.2%. Advanced economies will grow, but much weaker than the kind of the, in a sense, absolute terms, the contraction they are experiencing this year, close to 4%. And emerging market developing economies will go back to growth at about 4.6%. Now, in the report, we look at the latest collapse in historical context by going back to 1870 and examining global recession since that year, 1870. So in that context, global economy experienced 14 global recessions. In each of these episodes, global economy registered negative per capita growth per annum. 2020 episode is going to be fourth deepest one. There are two of these episodes. One of them associated with the First World War in 1914. Another one was associated with the Second World War, 1945 and 46. If you take out those two episodes, this is the second deepest global recession global economy experienced since 1870, after the Great Depression. This episode is exceptional for another reason. This year, we are expecting the highest share of economies registering contractions in their per capita GDP. In fact, we are expecting this year more than 90% of economies experiencing contractions in per capita GDP, a number larger than basically global economy experienced at the height of Great Depression. Let me turn to the second question. What are the likely implications of COVID-19? Now, that issue brings us to the question of course, the risks. Risks are heavily tilted to the downside. First, in the short term, we have risk of a deeper downturn. That could be because of a more protracted pandemic. It could be because of financial crisis, because of high debt levels. It could be because of re-escalation of trade tensions between major economies, or despite this overwhelming policy response, it could be because of limited effectiveness of policy as countries exhaust the policy space they have. Over the longer term, there is the possibility of a risk associated with slower recovery. And that could be because of lower for longer commodity prices, changes longer lasting on households and firms' behavior, risk associated with deglobalization in the context of fragmentation and a retreat from global value chains, and larger than expected adverse impact on potential growth, which I am going to discuss soon. Whenever these types of major crises take place, they are often followed by social unrest as incomes collapse. And of course, we are worried about weaker development outcomes down the road. Now, it is important at this point to take a snapshot of the spread of COVID-19, as the single most important risk is a more protracted pandemic. What you see on the left, advanced economies basically were able to get to the other side of the curve, and the number of daily infections were declining until very recently. You see an uptick there, and that uptick is entirely because of the outbreaks in the United States. If you take out that the United States from the sample, actually in advanced economies, number of daily infections has been going down. But if you look at emerging market developing economies, excluding China, there is a steep increase in number of infections. And this steep increase manifests itself in many regions. in Latin America and Caribbean, in South Asia, in Sub-Saharan Africa, in Middle East, North Africa, we see sharp increases. These are exactly the regions. They have limited testing capacity. So we might be underestimating the number of infections in these regions. Now, against this background, it is important to go beyond simple forecast and think about some scenarios. In the context of the report, we considered two scenarios in addition to our baseline. In our downside scenario, we are thinking of a more protracted pandemic and financial stress in multiple countries. If that scenario materializes, as shown on the left, global growth would go down to -8% this year. We also consider the possibility of an upside scenario. If countries are able to contain the pandemic and turn activity around faster than expected, then we will end up with a better outcome. But that better outcome will only give us a milder contraction, about -4%, which is still 2 times larger than the contraction we saw during the global financial crisis. There is very large uncertainty around the forecasts, as you see on the right. In fact, the dispersion around the forecasts is the largest we have seen since 1990 in the context of global growth projections. Now, the big issue is how global economy will evolve in the coming years if we basically look forward. There is no question there are very large output losses in the near term. On the left, you look at the level of output relative to our January 2020 projections. Even next year, when the growth comes back, there are large losses of output. The growth is not going to compensate in 1 year. On the right, you see the per capita GDP during global recession since 1960. And as it happened in 2009, it is likely that global per capita GDP will not go back to its previous trend for the foreseeable future. More importantly, when you have these types of deep recessions, you end up with lower potential output for an extended period of time, unless economies deliver growth and higher than their average growth for an extended period of time. So, in a typical recession, potential output declines by about 6% after 4 years. If that recession is combined with a financial crisis, the decline is around 8% after 4 years in cumulative terms. This is because of you basically experience a collapse in investment and also in productivity. There are multiple reasons why productivity weakens, including loss of jobs and, of course, missed time in the case of COVID-19 in schooling. Let me turn to the third question. What are the main policy priorities? Single most important priority is to deal with the health and economic crisis at hand in the short term. This requires supporting healthcare systems, helping vulnerable groups, and providing the necessary support for viable corporates. Coordinating policies globally to ensure smooth flow of critical goods is important. And coordinating policies globally to provide debt relief to the poorest emerging market developing economies is a priority. G20 has started the process, and the World Bank and the IMF have been undertaking necessary steps towards the debt relief initiative. Now, it is also critical to look beyond the crisis and putting in place policies for sustained long-term growth, given the kind of the damage I mentioned. In this context, there are certain things we know it is important. Number one, improving fiscal and monetary policy frameworks. Sooner or later, countries need to withdraw this large-scale fiscal and monetary policy support put in the system. At that point, they need strong frameworks to be able to execute the transition and normalize their policies. Enhancing debt and investment transparency is also critical. Undertaking reforms to improve flexibility in product and labor markets, making country more attractive for businesses and foreign direct investment going to be critical. Now, pandemic, by its very nature, a global problem, and it requires global solutions. This reminds us, once again, the importance of coordinating policies globally to address global challenges, including those related to public health and information transparency, global trade and financial system, and, of course, climate change. Let me quickly summarize. I asked 3 questions. The first one, what are global growth prospects in the near term? We are experiencing the deepest and most synchronized global recession since the Second World War. This will be the first time emerging market developing economies will see contraction in their output on record. Risks are still tilted to the downside. Second question, what are the likely long-term implications of COVID-19? This is an important issue. We focus a lot on short-term prospects, but we also need to think about longer-term implications of once-in-a-century crisis. And there, it is highly likely that we will come out of this crisis with weaker potential output, investment, and productivity over the long term. And finally, what are policy priorities? It starts with addressing the immediate health crisis, but also thinking about beyond the crisis with reform initiatives and coordinating policies globally. Now, whenever we talk about these deep recessions, there are questions about the shape of the recovery. And many propose during recessions a U-type, V-type, W-type, L-type, bed-type. And now I'm hearing swoosh-type recoveries. Let's make no mistake about the shape of the recovery. Whatever it is shaped, it is going to be a painful one. And it is going to be a difficult one to deliver for policymakers. The basic message is that history is watching policymakers and they need to deliver comprehensive, timely, aggressive policies. With that message, let me stop. Thank you.
Okay, thanks very much, Joachim. And thank you to Joachim and Renee for the amount of effort they've put into very quickly expanding the new program on COVID-19 and the macroeconomy. John and Ihan has both given very clear presentations about the state of the world economy and the degree of uncertainty that the world faces. What I want to do in this presentation is an update on a presentation from about a month ago with new results on different scenarios of the COVID-19 pandemic. This is based on a joint paper which has just gone up on the web today with Roshan Fernando, my co-author in this work, called Global Macroeconomic Scenarios of the COVID-19 Pandemic. The approach we take in this report is based on the work that I did earlier with Zhongwei Li and Alexandra Sidorenko looking at SARS and avian influenza. And what we do is we start with the epidemiological scenarios for all countries, focusing on virus infection rates, case mortality rates, and morbidity rates. We then take the epidemiological shocks and develop it into a set of shocks or economic variables in each country in the model, and then run a global economic to see, by varying different assumptions, what are the impacts on the global economy of various scenarios. Now, the early work we did in February this year, which got a lot of coverage, was looking at 7 scenarios. before there was even a pandemic, we just used historical data from previous pandemics to develop scenarios for what might be the next pandemic. What we're doing in this paper is we're actually using the data we now see coming out of different countries on the various case infection, case mortality rates, and as of the 20th of May, 2020. So we're not using any historic data now, we're using the data we currently have available. And we're not modeling how the virus will transmit across countries, which is what we did in the earlier work. We're actually looking at how it has transmitted across countries. The sort of shocks that hit economies from a pandemic are reduction in labour force. So we have people dying, people getting sick, people looking after people who are sick. We have an increase in business costs. So it costs much more to do certain activities in certain sectors in different countries. And a key part of this pandemic has been the shutdowns of parts of the economy. And so this affects the industries themselves, but it also has a big impact through production chains within and across countries. We also model shifts in consumer preferences, how people change their behaviour using data from electricity use and several different data sources. We also look at the impact on sector risk and country risk and households discounting future income, risk premium in the human capital equation. And we focus on the very large policy responses, which both John and Haihan have highlighted. Some countries have done incredibly large fiscal responses and monetary responses. So what are the scenarios in this paper? This is actually a different set of scenarios than the paper from a month ago. We vary the scenarios by looking at how many waves we think or how many spikes we expect to have in a particular year. So you see in this table, there are 6 scenarios. The first scenario is where we are right now. We have the wave as it was of the 20th of May. We project the epidemiological profile of countries that are still moving up the infection curves. And then we implement, we assume all the policies that were undertaken in this first wave across countries as of May 20 continue in this wave. Then we assume that because there's no vaccine, that the second wave in 2021 or the second round of spikes will be half as big. So we're modelling here 2 waves, an existing wave, a recurring wave half the size, and we assume that the policies that countries follow in response to the second wave of outbreaks look like the same policies that they follow in response to the first outbreak. Now we do vary that assumption later, and then there is no more pandemic after 2021. The second wave is we have an outbreak in 2020. We have it's the same outbreak in 2021. The third scenario is we have 2 waves in 2020. So countries are opening too soon, around June, July. Another surge in infections occur in the second half of the year. Because this is an annual model, we have to deal with the fact that these waves are being modeled as 4-month cycles. And so there'll be a much bigger epidemiological shock in this model. In the second year, we get 1 wave and then the pandemic disappears. In the fourth scenario, we've now got 2 waves in the first year. We've got 2 waves in the second year, but the pandemic does disappear in the future. And then the fifth scenario is a case where we look at, in the first wave, countries follow the policies they've followed so far with lockdowns. But when the second wave hits, they no longer lock down. So the countries decide there's no point locking down economic activity. We're just going to let the waves rush through like Sweden did. And so all subsequent waves will have no economic lockdowns. The problem with that strategy is this pandemic continues. And so the waves exponentially decline and it leads to a permanent increase in global risk. And the final scenario is a case where we actually run 23 different simulations. We pick a country, let's say Australia, and suppose Australia follows scenario 1, but the rest of the world follows scenario 4. So what if each country individually gets it right, but the rest of the world gets it wrong? And so there is actually 23 different simulations in the final scenario. So the model we're using is the G-cube model. I won't give much detail because people have heard this before in previous presentations. It's a global dynamic stochastic general equilibrium and computable general equilibrium model hybrid. It's used around the world. We take that model, we generate a baseline for 2016 to 2021 without any pandemic. We have assumptions about population growth, productivity growth, etc. We then surprise the model with a pandemic in 2020. And once the pandemic hits, consumers and firms know about the pandemic. 30% of firms are actually forward-looking, so they know the assumptions about the future. 70% are just following a rule of thumb. What we're using then are the actual data now for case infection rates and case mortality rates as of the 20th of March, 2020. Now, in the results, in this table, there's a lot of information. It's very important to understand these are not growth rates. What we're showing here is across the top is each scenario, and then down is each country. This is the percent deviation of GDP in 2020 relative to what it otherwise would have been. So for example, take Australia, we say GDP will be 8.5 to 7% lower than it would have been. If Australia's GDP was growing at 2.57% in the baseline, then the actual growth rate in 2020 would be -6. So again, these numbers are much more negative than the presentations from John and Ihan, because we're looking at percentage deviation from base. We're not looking at the actual growth forecast. What you can see immediately is this is, as the others have said, a major shock to the world economy, a very serious economic recession in the first year. As you move across the various scenarios, we're getting more and more waves of pandemics. You can see that the losses in GDP get bigger and bigger and bigger. And as you get to scenario 5 you can compare to scenario 3. In scenario 5, you no longer do lockdowns after the first wave. Scenario 3, you continue to do lockdown policies. You can see that in all the cases, removing the lockdown policies does lead to less economic loss, but if you look at the dynamics, it leads to larger long-term losses. And if you compare scenario 6, for example, for Argentina, if Argentina gets scenario 1 and the rest of the world experiences scenario 4, then their GDP will be -12.56 instead of -11.42. In other words, they lose about an extra 1 to 2% of GDP from the impacts of the world pandemic on their economy. And you can see that it's consistent across each of the countries in the model. Now, there's a full set of results online, and the paper itself, I'm told, has just gone online. If you go to what we call the macroeconomic modeling results dashboard, you can actually get a sense of the various results of various countries. So here we have the dashboard, and then we have the summary of the scenarios. What's interesting is you can actually look at the results in a graphical sense. This shows the change in GDP that are in those tables in scenario 1, and there's various levels. The green is losing between 10 and 15% of GDP. Blue is between 5 and 10% of GDP. Yellow is between 20 and 25% of GDP. So you can see South Africa here in particular takes a very big hit. As you move through the scenarios, you can see that the losses are getting bigger and bigger and bigger. And so by the time we get out to scenario 4, Brazil, for example, is in the range of 20 to 25% reduction in GDP. And South Africa is getting to 30 to 35% reduction. So you can see, again, quite a large dispersion across countries under the different sets of scenarios. All of these scenarios are plausible. So the uncertainty just in this range is as you can see, extremely, extremely large. The other thing which is interesting, if you're looking at how we create these scenarios, we're doing projections on the epidemiological outcomes. For each country, we make an assumption about what we've observed, and then we project the rest of the epidemiological outcomes country by country. Let me just finish by focusing a little bit more on the dynamics. So this shows you the results for Australia. The top left-hand chart, again, is percent deviation from the baseline. So scenario 1, which is a plausible scenario that we're in now, Australia's GDP is 8.5% below what it otherwise would be. And in the worst case scenario, we get down to 12.6% loss of GDP. This is a very serious loss in economic activity. You can see the patterns are very much a flat and V-shaped recovery for GDP. Unemployment is fallen by 6% in the scenario we're currently in, but can easily fall by 9% or 10% depending on the number of future waves. This shows how important it is to make sure that you keep the health pandemic characteristics under control, because falling a bad outcome from an epidemiological point of view leads to a very bad outcome from an economic point of view. One thing I'd like to stress too is if you look at the red scenario here, this is scenario 5. This is the case where you don't do any lockdowns in the subsequent responses, but there's a permanent increase in global risk. And as you see, the world economy changes. If the world becomes riskier forever, then GDP will be lower, the optimal capital stock will be lower, investment will be lower, and it will be much harder to get jobs back after the economy recovers. One final point, there's some more results here, but if you look at the sectoral results, it's quite interesting that, you go back. If you look at the sector results, you can see for employment, each sector is hit particularly hard. Energy, mining, the biggest loss to employment is occurring in the manufacturing and service sectors. One thing to note that in the one scenario where in fact the world is totally changed and risk is permanently higher, those sectors that are heavily involved in producing goods that go into investment are the sectors that lose jobs permanently. Mining, energy, durable manufacturing. So this is a case when there's a permanent shift in global risk. This shows you how important it is to have the scenarios, to have the epidemiological control for long-term economic growth. So let me just finish off. I agree with just about everything that both John and Ian had said about the greater importance of coordination of public health and macro policies. There really is an important time for the G20 to step up. As they did in the global financial crisis, there needs to be greater coordination of macroeconomic policies, particularly fiscal stimulus in countries that are constrained either because of institutional factors such as being in the Eurozone or because of lack of access to finance. A big issue, I think, which Ian touched on, which I agree completely, is we really do need to reassess global institutions. We need a World Health Organization, maybe not in the form it is now, but we definitely need to improve the global institutions for dealing with future economic and environmental shocks. And what COVID-19 shows very clearly is the folly of isolationist politics and isolationist policies when the natural world ignores artificial borders. And so it's a very clear case and a very good warning system for how we might design future policies related to climate change and a whole range of known knowns coming our way. And I'll stop there. Thank you.
Thank you very much, Warwick, Sean, and Ehan. Now I will ask the panelists, please to turn your camera on, and we will start with a question. The first question is from Sad Daihan. Please ask your question. Yeah.
Thank you, Hoim, and thank you to all the panelists. My question is particularly to John and Ian. There was, I mean, now the IMF has sort of further revised the forecast downwards, but for the earlier forecast for both the IMF and the World Bank, there was a bit of a criticism that it didn't match the COVID narrative, in a sense that there was this paper, particularly by CGD, saying that the forecasts were quite optimistic. And we knew from the beginning that, particularly for the poor in developing countries, because of the poor health system, poor governance, less fiscal space, and less effective monetary transmission, it was going to be hard hit. They were going to be hard hit. So I wanted to know more about what was the thought going on with the IMF and the World Bank in terms of the forecast around those times. Thank you.
Sure, I can weigh in a bit. So when we formulated our April 2020 vintage of projections, we were, those really came together in March. And so part of it was that based on the best evidence that we had pulled together then, there was this somewhat larger impact in many advanced economies than say in low income countries there. But as you see, as more information has come in and we start to understand things a little bit better about the propagation properties of the epidemic and where the vulnerabilities are, the fund we've revised down pretty substantially. And in particular, you'll see, I showed one slide that shows that actually relative to earlier expectations for emerging market and developing economies, they actually now do much worse than advanced economies.
Thank you. This is an important question. I received this question multiple times so far, whether we are underestimating the damage in emerging market developing economies in terms of growth this year. The answer is no. When we think about these forecasts, we need to think about not just the point forecast. We need to think about the potential growth of these economies, and we need to think about expected growth outcomes. So the first thing, the potential growth, obviously these economies have much higher growth potential. They tend to deliver higher growth. If they come down from that high growth, of course, they will come down relatively, the smaller distance, what you expect in the case of advanced economies. Now, the second issue is related to the first one, what we were expecting at the beginning of the year. And if you look at what we were expecting at the beginning of the year and how much growth numbers downgraded, they're pretty much in the same ballpark. And if you go a step further and think about, some countries outside of the emerging market developed economy sample, for example, China, which we are expecting to deliver positive growth this year, given that it experienced the pandemic before other emerging market developing economies. In fact, the downgrade in the emerging developing economy sample is quite sizable. So there is no, in a sense, underestimation of the damage. And the third important issue, whenever you have these types of forecasts in the midst of a unprecedented crisis, once in a century episode, you need to think about scenarios, which I discussed and John discussed IMF scenarios as well. And if you look at those scenarios, we are looking at very large contractions in emerging market developing economies. In our case, our baseline number is -2.5, but the downside scenario implies that number could be at -5 this year for emerging market developing economies. But let me stop there. Thank you.
Thank you. Now we have a question from Wishu Maradika. Sorry if I didn't pronounce well.
No.
Yes, please go ahead.
Thank you for the opportunity. I just have a quick question about the World Bank's debt relief program for emerging and developing economies. Will the program going to be conditioned by policy reform commitments from countries, such as strengthening the fiscal and monetary policy framework?
So that relief program is kind of a program endorsed by the G20, initiated by the IMF and the World Bank. The program does not require, the type of conditionality you have. You just need to apply for the program. So this is a different type of initiative than the standard World Bank IMF lending arrangements.
Okay, then we have now the last question from Mark McKinsey.
Mark McKenzie. Thank you very much. Thank you very much for your excellent presentation. My question is to John and Ayan. I'm from the CSEN Center in Kuala Lumpur, Malaysia. My question is related to the first one about whether or not the IMF and the World Bank, despite the revision in the outlook and forecast, whether they're still being overly optimistic. And the basis for my question is really that the virus is still out there, the health risk is still persistent, but we know that from this, unemployment is going to be rising or continue to increase around the world. We know that this will contribute to the widening of the income gap, particularly between advanced, emerging markets, low-income countries. And I have a vested interest in this question because I am from Jamaica. I'm an immigrant in Canada. I'm working in Malaysia. So I'm a part of globalization. So I think this gap is we're likely to see rise in social tensions, political tensions. And the question then is, are we factoring these other risks, these other issues that will arise as a result of COVID-19? The health risk is still there, but other things are related to it, bankruptcies, etc. So are we still being overly optimistic? Thank you.
So I can take it first. So I'm going to, I guess, echo a bit to what Ayhan was saying to the earlier question, but also kind of what both of us have in our respective presentations is the uncertainties, of course, are extremely large. And one, you've highlighted essentially a number of those. One is, the path of the pandemic. Another is there the possibility for a rise in social unrest as a result of the pandemic and the associated economic dislocations that we see. All of these things, rise in inequality, rise in poverty, they could be larger than, say, are incorporated under the baseline. And it's for that reason that, we have these, downside scenarios, which have those kinds of features that are amplified. I mean, in some sense, when uncertainty is so large, focusing on the projection, it's in some sense maybe a better way to talk about it is that it's our baseline scenario. And that really there's a whole, kind of similar to how Warwick was presenting, right? There's a multitude of possible scenarios out there. And I think that that's maybe a good way to think about it when we are facing this kind of profound uncertainty. And the baseline represents our best guess, but we also are very upfront and want to acknowledge that the uncertainties are really, really large. So, yeah.
Thank you, Mark. You are raising kind of an important question. As I showed in my presentation, the number of infections in emerging market developing economies is increasing at a rapid clip. So the question is that whether this crisis could turn into a different type of crisis we are not thinking of at the moment. Now, when you think about crisis, one constant is that there is the kind of the unpredictability. Crisis can turn into different type of crisis down the road in unexpected ways. Think about, the global financial crisis, how it evolved. It started in the US in a small market segment. It basically took over the US financial markets, spread to European markets, and then it became a kind of a global crisis. And it did not stop there. Of course, it triggered a crisis in the Euro area. It triggered crisis in Europe, Central Asia as well. Now, in the context of this crisis, it started as a health crisis, turned into very rapidly an economic crisis, and it won't be a big surprise. It will become a financial crisis, at least in some countries around the world. Now, the big issue is that if we are just producing these projections, we need to think about basically a reasonable baseline and scenarios around that baseline. And this reasonable baseline we have in the context of the World Bank forecast suggest a truly historical collapse. Could it be worse than this? The answer is yes, and that's our downside scenario. Even our upside scenario implies a contraction in global GDP 2 times larger than what we saw in the global financial crisis. So it is important to keep these things in mind. There are, a number of risks I mentioned. One of them is the financial crisis. Another one is, possibility of social unrest. So we are really thinking about this year and next year with these forecasts. There are basically long living scars associated with these episodes, and how those scars translate into different types of crisis that has to be seen.
So Joaquin, can I just add to the comments? Because I think Mark and some of the other questions really made a really important point. The messaging really does matter, because the only successful policies, for example, for Australia, succeeded because there was concern about this was going to be extremely serious. The economic modelling that I did and the epidemiological modelling that the experts did in that space, they scared a lot of people, and the government took action and explained and brought the people along. You won't get an effective contagion reduction if in fact the people don't believe you, or if you're getting mixed messages. And that's the big mistake in the US. That's the big mistake in the UK. You can't say this is really bad, and have the president or the prime minister saying, in fact, it's not that bad and it's going to go away with magic. So messaging really matters. And so even if they do end up coming up with a vaccine, that's not going to solve the economic dislocation that Ayhan and John and my model shows, not for a very long period of time. And the bit I don't understand are the financial markets, how they can be pricing in US equity markets and other equity markets that this is just a minor event, when in fact we know it is a major event.
Thank you, Warwick. Now, Andrew, you want to ask your question? Let me unmute.
Okay, are you?
Yes, you're okay
now.
Yes.
Okay. Look, thanks very much to all those authors, and Ayhan and Warwick and John. It's appreciate that. Question there. I mean, I don't disagree with any of your analyses there, but I didn't see much in the way of any upside potential at all. So the fact that we're doing this by Zoom in itself, and congestion's a big cost around the world, and off office working and so on. I mean, is there something there, particularly, and you'll remember, and Warwick, you'll remember when the Rand Corporation at Brookings presented some work on, there's long lags and there's productivity and the digital disruption. So whether or not this has brought forward a whole lot of productivity work. So that's maybe, are you underestimating a positive there? And Warwick, specifically, what is in your baseline? What have you assumed, right? The other one, though, there's a negative, is one that is the social unrest. As you know, that anytime there's a large disruption, global financial crisis or war or whatever, there's gainers and losers. Some people lose very badly. Some people aren't as able, whatever, to adjust and adapt. And so you get rising inequality. And also with high unemployment, a job is, as you know, is far more important than just getting some money to go and buy some groceries. It's your social contact and everything else and so on. So then you get a lot of unhappiness, and the social capital is, even the Bank of England there, they're writing about now the importance of their social capital. So are you underestimating that risk? I mean, I appreciate your other risks. You've got the risk of the pandemic, the financial risk, the trade risk, you can see all these. But is that one that the OECD seem to emphasize that in their last assessment? So are you putting too little weight on that negative, and maybe not enough weight even on the positive? So question to all of you. Thank you.
Sure, I'll take a stab. It's certainly the case. It seems likely that there's going to be some hastening of trends towards greater automation, and things like digital payments and the like, which may well have some kind of productivity consequence, you know, but probably more for the future. I would think that in the near term, at least, probably productivity is negatively impacted, in part because there's having to be this adaptation of all kinds of production processes to take account of the fact that we have to try, we have to rejigger kind of the way we do things in order to reduce the likelihood of transmission and all of these things. And that comes with a productivity cost. So think about, just very simply, restaurants where now everybody has to be socially distanced. They can only accommodate perhaps say 25% or 50% of their usual capacity. And so that manifests as this kind of lower than usual productivity. And that's, you know, given that it seems likely that this may take a while, that seems like that will be with us for a while. On the second, in terms of, you know, the social unrest, the costs, I guess, associated with that, I think the point is well taken that it could well be that we are not fully appreciating the costs associated with reallocation from economic dislocation that's going to result from this crisis. And if that's the case, then, you know, we're in for a much slower and more sluggish recovery. So I take both of those, I take that point also. Thanks.
Yeah, Andy, you addressed one of your questions directly to me, so let me just chime in here. So as you know, we've just published a paper through Brookings looking at the various scenarios of singularity and movement towards a faster uptake of artificial intelligence and a whole range of digital economic improvements. And you can get a very different world, but it takes a long time for it to emerge. And what you see in the short term will be dislocation of jobs. And so if you have this positive productivity story, it will probably shed labor, because the labor saving technology is what's been adopted because we're trying to save labor. And so you're probably going to see that countries that have good safety nets will perform much better than countries that have either none or poorly designed safety nets. So I think the design of policy during this transition is absolutely critical, whether or not a country will fall into the social unrest category or the thriving economy. Right now, I think it's very clear that the productivity shocks are negative. In fact, that's how we model the increase in cost. An increase in cost is exactly the same as a reduction in productivity, because you're producing less with the same amount of inputs because of the extra costs involved. So right now, productivity is definitely negative, but you do make a valid point, and we have looked at that in a separate paper.
Thank you, Andrew. It's good to see you, at least on screen. About your question, there is this issue of whether we are not appreciating the downside and upside risks. Briefly about the downside risks, I think this is a period you can be infinitely pessimistic. There is no question about that, and you see, you know, a health crisis, rapid increase in the number of infections, the mortality rate. So there are reasons to be, you know, to be pessimistic, and even these best forecasts suggesting a historical contraction. The risks in terms of social tensions, in terms of financial crisis, in terms of deglobalization, in terms of, you know, policy ineffectiveness, they're all, I think, out there. If they materialize, we might end up in a kind of a worse scenario, and all of these scenario exercises are about that. About the, you know, the productivity story. In the report, we look at what happens to productivity after major health disasters. Thank God we don't have, you know, a pandemic we can basically take as an observation, but we do have these epidemics, like SARS, Ebola, Zika, MERS. If you look at those episodes and think what happened following those episodes, basically 5 years after those episodes, you see a kind of a substantial decline in investment relative to baseline and a substantial decline in productivity. Now, in the context of course, COVID-19, if there is one major change, is the change of, how much we use technology as we are doing right now, and ramping up digital facility we have, and improving, in a sense, efficiency in terms of communication. And that might answer one question we often discussed, actually, at Brookings panels, comma panels as well, whether these technological innovations will turn into a surge in productivity growth sometime in the future. The basic idea who supported this argument, the basic idea of those people who supported this argument, the productivity surge argument, was that whatever these new technologies, they are not general purpose enough. They are not used by the masses. And now, because of the pandemic, we really see lots of people are using technology in the way they did not use before. We are using it at work, we are using it in educational institutions, we are using it in retail transactions. We pretty much use it everywhere. So there is this question, of course, 3, 4, 5 years from now, we might see the type of surge these colleagues, academics, experts, they were expecting this surge in productivity. But whether it will happen, it has to be seen. As Warwick mentioned, there is this long period of delays to see these types of big jumps in productivity, and many things have to come together. I think in this dark times, it's good to be optimistic. In that sense, I really appreciate the question you asked. Thank you.
Okay, thank you very much to all of you, all the questions. We have come to the end of our session. It has been a pleasure to spend the last hour and a half almost with Sean, Ian, and Warwick, and all of you. I know that it's getting very late in Washington too. Let's just conclude with this session, and you are also, everyone is invited to next week webinar by Barbara Buchner, Frank Schotzo, Adeline Morris. And you can get all this information from the CAMA website. Thank you very much to all of you.